this episode, I discuss one of the more advanced topics in IBC, strategic loan balances. We'll dive into what is a strategic loan balance, who can benefit from having a strategic loan balance, and why they're not for everybody. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. Well, everybody, welcome back to the show. This is Nate taking it solo today to discuss a topic that has really been fleshed out in recent years. But before we even dive into it, I really wanted to send out a thank you to everyone who listens to this. You know, it's such a pleasure to be able to do this. I didn't know for sure if I would love doing podcasts, but I've really fallen in love with it. And honestly, the encouragement we get, the emails we get, the reviews we get are such a huge blessing to me. I'm just so thankful to have the listeners that we do and to have them reach out and just tell me how much they're loving the content. So we love doing it just as much. I wanted to send out a quick thank you. To those of you who are brand new to IBC, I still think you'll love this episode. It just may not answer the questions you might have. It's definitely going to be an advanced topic. So we're going to talk about what we call strategic loan balances. And it's a term I use to describe something in particular. So a strategic loan balance, when I use this term, I'm referring to something specific. And we're going to spend this whole time fleshing out what it means. And we're going to spend this whole time discussing examples of when it makes sense to do one, and also letting people know that they're not for everybody. So we'll see where we end up. This will be very fun. But a strategic loan balance is simply a loan balance that you are going to create inside of your infinite banking system, inside of your policies, without specific terms on how it's going to be repaid. That's essentially the idea between carrying with you a strategic loan balance, is that you're going to borrow money to fund things, and you know at the outset that you don't have any cash flow available really to repay the loan, but there's a reason you're taking the loan out anyway. And in fact, for it to be a true strategic loan balance, you will have an idea, or you will have a game plan. You'll be able to have some sort of vision for what the end game is going to be for taking out this loan balance. So that's what we're going to spend our whole time talking about. What is this idea of a strategic loan balance? I felt like it was important as we get started to also mention a few things in general. So first off, for those of you who are doing IBC and those of you who are even new, I think one of the first things people will learn by people like me or on YouTube or anywhere along the way, you will find out that when you take policy loans from the insurance company, there is no set repayment term given when you take out a policy loan. This is why we call the term, I think is valid for what they're offering to you in the form of policy loans, is a interest-only line of credit for life, which means you can request policy loans. There's no amortization or repayment terms set up. In fact, even if you want to repay it on set terms out of your own volition, your own free will, you don't even have to tell them that that's your plan. You just ask for money and they send it out. All they want is interest once a year at your policy anniversary. They bill for the interest that has accumulated on whatever loan balance you've had outstanding over the course of the previous year. So this is what is offered. The reason why this is an advanced topic, strategic loan balances, is because in general, we do not recommend taking loans from the insurance company and just choosing to not repay them. I want to make this known. If you're going to use the policy, we expect that you would understand the banking idea requires you to repay and reuse and repay and reuse. I think some people can get lost, especially whenever you bought into IBC from spending time on YouTube and marketing videos and all these clowns out there who have a camera and make videos. If you don't change your perspective and your paradigm to learn how to operate inside of this new world, then you can make some big mistakes. One of those would be, well, since I don't have to repay it, my agent says I don't have to repay the loans, I'm just not going to repay them. And we get weird with it. And what I'm saying is the strategic loan balance, just because I'm going to present to you an idea that you can understand about not repaying loans. First off, it's not for everybody. And second off, as you'll find out, that's not actually a normal recommendation. The normal thing to do is to borrow money from your policy and repay it in certain ways depending on what you used it for. So I wanted to get this out of the way before we dove in specifically to strategic loan balances. So what I meant by that, you're going to borrow money from policy and depending on what you're using it for should determine how you pay yourself back. If I'm going to borrow money from a policy to purchase a vehicle, a car, it is a logical progression. Though not required, it is a logical progression to say that I am going to repay my policy in a similar manner to if I had borrowed money from a bank and we're going to make payments back to them. But that may look different than if you were to borrow money from your policy to make an investment of some sort. And let's say the investment, you may not amortize repayments back to the loan. In that way, you would expect to repay the loan in one of two ways. If you use it to make an investment, you would expect to fund money back as classified as loan repayments to the insurance company when the investment starts to produce a return. So you may not actually amortize the loan or commit cash flow to it. You're just going to simply say, I'm going to invest in, whatever this investment is. Let's say it's a cash flow producing thing, maybe like a real estate investment. And I'm going to take the income coming from that investment and I'm going to roll it back into the policy as loan repayment. Not on an amortized fashion, but I'm just going to take money as it comes in and stick it back into the policy. That'd be acceptable. There would even be an acceptable way to regarding borrowing money to make an investment if it's more of an appreciation based, where it may sit there for 3, 4, 5 years and doesn't produce cash flow, but then has a lump sum payout later on in life. I wouldn't even call that a strategic loan balance, by the way. So let's go ahead and dive in. What is a strategic loan balance? It's whenever you're going to accumulate a loan balance at the insurance company on purpose for specific reasons. And at the moment you do it, there is not exactly a repayment agenda set forth, but it also does not require you to be unwise. So let's go ahead and dive into what this really means. Nelson Nash has even talked about this in his book, especially with the Warehouse of Wealth book, his second book that he wrote. In all of our lives, there comes time, or it's very often that some of us will experience a financial windfall at some point. And so having loan balances inside of policies allows for future windfall money to come in. And so he was essentially describing how you could create a system and have some loan balances inside of the system that you haven't been repaying on purpose, but you had a feeling you'd be able to in the future based on X, 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 and X. So let's go ahead and dive into some of the details about what is a strategic loan balance and how it may come about. Inside of a strategic loan balance, oftentimes there are certain particular instances where it can make a lot of sense. There are also some danger zones within this. And so it's not for everybody, but it can be useful. And so I think it would almost help you understand what I mean by a strategic loan balance if I describe the usual situations that it makes sense to have one. So think with me on a few things. I'm going to take us through a journey here on strategic loan balances. When would it ever make sense to borrow money from the policy and not exactly have a set repayment term or known repayment event in the future? Yet, we also feel that it's likely it will be repaid, or we understand that it won't be and we know why it won't be and we're okay with it not being repaid. So what instances does it make sense? There's actually quite a few, so I'm just going to name off maybe 3 or 4 to help everyone see what we're talking about. One of them could be this idea. Let's say we have an individual making good money who's a business owner and his income is volatile. And so some years they may have a really high income, some years it's going to be lower, and they're trying to build out their IBC system. They're very committed to this idea. They've listened to my episode 173 podcast where I described that ideal infinite banking as situated in our lives is every dollar of free cash flow is going into premium first. So they say, Nate, my income is volatile. I want every dollar of free cash flow of my income going into premium. But it can be hard for me to build out a system with my income being so volatile per se, between 1 year making 500,000, the next year making $1 million, and anywhere in between. I don't want to overextend myself. I don't want to make some mistakes, but I want to be able to stuff money in. So think with me along these lines. Let's just say, we say, okay, that sounds great. We'll go ahead and build out a policy premium based on some sort of expectation. And maybe they're even getting policy premiums that force them to be a little uncomfortable with the amounts. And so they're funding their policy. And let's just pretend that $100,000 a year is going into their policy. That's what they want. And that $100,000 a year is going to be the base premium and also the maximum amount of paid up addition rider premium that can go in. In other words, we're saying they're going to put in $100,000 a year, and that $100,000 is going to max out their policy. So in other words, it's the most money that can go in, the base premium plus as much PUA riders they can stuff. The MEC limit is going to be $100,000, and they're trying to hit it every year. Good for them. They can come to me in 1 year and they can say, Nate, this year it was a little bit down. We had some issues crop up, and so we don't actually have $100,000 of free cash flow sitting around to write a check to max out this policy. What should we do? Well, this individual is left with essentially one of two options. They could choose to do option number one, which will not involve a strategic loan balance. They could just simply choose this year to write a check for $50,000. That's what they have. And just simply not max out the PUA rider for that year. They could just pay the base premium plus put extra towards the PUA rider, and they could just put in $50,000 instead of $100,000. And that would be perfectly acceptable. Remember, the paid up addition rider is flexible, which means you never have to max out if you don't want to. You can put as little in or as much in as you want. Some insurance companies are more flexible than others in their allowances for moving that around, but nonetheless, it's never actually required piece. So they could always choose to stop funding the PUA or to reduce it or whatever it is. That could be option number one. Maybe if they have a flexible PUA rider, they could add more later in the year if it comes available. There is another option though, and this is where the strategic loan balance comes into play. So this individual could, at that moment, say, you know what? Or Nate, me, could say to this person, you could also choose to take out a policy loan for $50,000 is what you actually could choose to do at this point in time. And so you have $50,000 in cash already that's going to go into the premium. You could also choose to take on a policy loan for $50,000. And so you have $100,000 to work with, and you could write a check for the full $100,000 to max out your policy for the year. And the policy cash value will look just like it would if you had wrote a $100,000 check, because by the way, the only difference is going to be there's this $50,000 loan balance on the policy now. And so this is what we would call a strategic loan balance. And the reason we call it the strategic loan balance is because the only reason they would choose this option is if there was some strategic idea as to why it made sense for them to carry that loan balance. I think it should be pretty clear with all of this that they are not going to set up an amortization schedule for that $50,000 policy loan. They didn't go out and buy a car with it. They didn't invest it into a property that's going to be producing income. They didn't, spend it on taxes that they owe this year and they'll probably owe next year. So they're not going to refill it up with tax money that they'll borrow out again. They're not going to do the normal things with this loan balance. There is not a set repayment for this loan balance that's in existence. So the question is, why would they choose this option? The reason they would choose it is because of the fact that their income goes up and down. And so they would say, well, this year we only had $50,000 of room. Maybe next year we would have more than $100,000 available. So what this allows them to do is every year into the future, they are still, of course, allowed to put in their $100,000 of premium out of their cash flow in this instance, in this hypothetical scenario. And they also have this $50,000 loan balance that was used to max fund a paid up addition rider premium that year. And anytime in the future, they can dump in essentially a total of $150,000 in any given year into the future. $100,000 as premium and the other $50,000 as loan repayment. Remember, if they had not included their strategic loan balance, their MEC limit was only $100,000. So that was the max contribution they can make any given year. And so now that they have borrowed the money out, they've allowed that money to compound in the policy. They would have paid some interest on the loan. They could have let it accrue, but I'm just merely saying there would be interest either accruing or they would have paid it on the loan, of course. But what we're saying is it's going to allow them to dump in extra money into the future. So the net effect is a much more flexible yearly contribution. And the net effect actually works both ways, which really means for all of you, I'm actually going to do another podcast on this later about how to manage volatile incomes. We've been talking about it lately. It's a common question we get. Honestly, this is going to have a lot to do with it. So it's going to be reiterating some of these things. But the idea is just the knowledge that you can use the cash value to max out policies in down years and then in good years replenish the loans that you took in the down years. And so your policy is always looking as if it was maxed out every year is a very cool strategy. So the strategic loan balance concept is the idea that we don't exactly have a specific reason or way that we're going to repay this loan in this guy's instance. However, based on their life, we understand that it seems likely that at some point in the future, there will be a financial windfall allowing them to repay it. In this guy's case, it would be just an income windfall. Like there will be good years and bad years. And we may accumulate strategic loan balances in the bad years just by our own volition. Remember, in this guy's instance, he didn't have to borrow money to max out the premium. Option one was just put in less PUA rider premium. As always, everybody's option number one. It's easiest to do. Whether or not you borrow money to max out the policies is based on whether you want a strategic loan balance, which should be based on whether you think you'll be able to fill up that bucket in the future. So that all of that was in place, and that person said, you know what, it does make sense. I want to max out the policy every year. I'll borrow in the lean years to max it out. And then in the normal years, I'll be able to max out with cash flow. And in the very good years, I'll be able to max it out and repay the loans I took in the lean years. And it just creates an even flow of capital. And so that's one concept. We have other clients who are actually doing this in other ways too. By the way, if you are listening to this podcast and you have not watched the 4 stages of IBC commitment webinar that's on our website, I have brought it up in the past couple months every show. Because if you haven't watched it, you need to watch it. And if you've only watched it once, you need to watch it again. I promise you, you will not be disappointed. I think it's one of the most fundamental conceptual things that you could learn. I've had so many people watch it, and just been blown away by how simple it made them understand the system. So first off, make sure that's understood. The next reason it could make sense is that you may have some people who want to do a strategic loan balance. A lot of times, if you already have every dollar of free cash flow going into policy premiums, if you want to go beyond that, it requires a strategic loan balance, but sometimes it makes sense. So we'll have people talk to us for regular lifestyle things, paying for regular lifestyle style situations, especially ones that are a bit of a larger ticket item. So for me, those would be my annual tax bill, rather large, and also my charitable giving. These are very common things to start financing from policies. And so you would pull out a loan to pay your tax bill every year. Sometimes what we'll actually do is we will capitalize a policy that we will use to pay for taxes or for charitable giving. We'll actually capitalize a policy to do that. However, if we're going to build out a policy to do that, and you already have every dollar of free cash flow going to premium, the only way that we'd be able to fund a new policy to take over the tax bill every year would be through borrowing. And so sometimes what we'll do is, instead of using your cash flow, your income, and setting money aside from your income to pay your tax bill in April, sometimes what we'll do is we'll just go ahead and take out a policy loan to pay the tax bill, which then allows all of that cash that is now not required to pay the tax bill. You can now use that, if you wanted to, of course, to capitalize a new policy. If we did this, that would require, let's say, for 4 or 5 years of funding a brand new policy using your tax cash flow. If you were going to take your tax cash flow and fund a policy and then borrow money, likely from existing policies, maybe incorporating the new one too, to fund the tax bill, there is not going to be cash flow specifically to repay the loan balance at the time. Why not? Because we're choosing to use the cash flow to pay premiums instead of loan repayments, so we can get a new policy out of this mix. In this idea, we could choose to borrow money from policies to do things that we're going to do anyway, just to allow us, like paying taxes or charitable giving or something of that sort, just to allow us to have more cash flow available to pay premiums, so we don't have to divert our cash flow to do it. But if we're going to use the cash flow to pay premiums, we can't pay the loan back at the time. So that would create a strategic loan balance. Why would somebody want to do it this way? Once again, it's going to be based on the likelihood of being able to fill up that loan balance in the future. So this is why we say it's not for everybody. It has to be strategic, it has to be well thought out. First off, you have to know that you're going to carry a loan balance with you for a period of time. You have to know why you're carrying the loan balance for a period of time. And you have to know whether or not it's likely or not that in the future there will be some sort of windfall event that can help you manage the loan balance. It's true that you could just choose to never repay the loan balance and you could just die one day. The death benefit's going to pay it back. In fact, that could be someone's picture in their mind. I'm going to build out this policy. It's going to give me a big death benefit. I'm just going to pay interest on the accumulating policy loan, and I'm never going to pay back the principal, and I'm just going to die with it. And if I happen to have a windfall of capital that I can use to repay it, that's great. I don't even expect one, but I'm cool carrying the loan balance, just paying interest and dying with it into the future. I don't really mean to overcomplicate it, but what I'm saying is the whole idea of the strategic loan balance is to expand your system beyond what your cash flow would allow you to do today, but knowing that there's some reason that we're doing it. We expect some things into the future. A lot of people who do end up using strategic loan balances are business owners, entrepreneurs, investors that may have assets running around that will probably be liquidated at some point. And I'm going to dive into a couple more of these things, but essentially it's a certain subset of the population would end up enjoying strategic loan balance. You can't be using one if you're timid about the system, by the way. If you're kind of nervous about policy premiums, this is only for people who have gotten over their nervousness of policy premiums. Understanding the reality of what a strategic loan balance is can help people overcome their nervousness. The idea that I can use cash value and policies to even help me fund premiums and max them out for a year if I choose to, on top of being able to reduce PUA premiums. All of these things can be helpful in calming some of those fears.
Is the money in your bank account losing value instead of growing? Are inflation and taxes going to get better or worse? Conventional banking makes the bank rich using your money and pays you little to nothing in return. We believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to beat the banks and inflation. Visit livingwealth.com/beatinflation. You'll receive instant access to what we call the beginner's course. This in-depth and easy-to-follow course teaches people how to create and profit from infinite banking. You can become debt-free, in control, and achieve financial security and significance. Stop letting the banks and Wall Street dictate your financial future. Go to livingwealth.com/beatinflation today to instantly receive free, no-obligation access to this priceless course on infinite banking. Again, that's livingwealth.com/beatinflation. Now back to Nate and Holly.
So we have the option of evening out income fluctuations that can help create strategic loan balances, can be useful. We have the option of using policy loans to pay for things that we're normally going to pay for, which frees up cash to be able to pay more premium than we otherwise would have been able to pay. Accumulating a strategic loan balance, and we have some reason to expect it into the future. All of these kind of flow together. So the next few things will be ideas that could have also been incorporated in the previous ones. So we've got clients too who are expecting an inheritance one day. Maybe they have parents who, wealthy parents just simply means they have some money to pass down and they know they're going to pass it down. And so you have clients in their 50s, their parents are in their 70s, maybe even getting close to 80s, and they know that there's a lot of money sitting in various assets that their parents have that are going to be passed down one day. So we've had clients tell us like, man, I see this coming in the future. I would love to be able to get that money into policies, but I don't really know when my parents are going to pass away. And everybody knows as you get older into your 60s, maybe even into your 70s, life insurance can be harder to get approved for. Not because it's hard to get approved for, just because our bodies age and decay, and it's common to get medical issues as you get older. That just makes life insurance a bit more difficult to get. And honestly, a policy started in your 50s is going to look a little bit better than a policy started in your 60s, which is going to look a little bit better than a policy started in your 70s. And so with all of this being said, they would come to us and say, is there anything I can do now to prepare a place for this? That's also the definition of strategic loan balance. It's preparing a place for future windfalls. At its fundamental, that's what it is. So the idea is if you have a system of policies, you can use policy loans to help start a policy, just like we already talked about. We'll borrow money to pay your tax bill or to give your charitable giving every year from policies. And then all the cash flow that you used to pay towards charitable giving, you can just use to pay premiums if you chose to, or all the cash flow you chose to pay in taxes, you could just simply fund into policy premiums. So you can start a new policy without any quote unquote new cash flow. Instead, you're using policy loans to free up cash flow that used to go to other places that now doesn't have to, so you can go pay more premiums. And so the idea, though, is that it will accumulate a strategic loan balance. And the reason it's strategic is because we do not have any fundamental preparation in mind to repay it right off the bat, but we know in the future some events are going to happen. In all of this, though, you would want to run the numbers to make sure that even if you never repaid the loan balance, things would go well. But the idea is it would be beneficial for someone in their 50s to do this for 10 years. So they're 55. By the time they're 65, maybe their parents have passed away. They receive an inheritance at age 65, and they get $1 million, and they maybe have accumulated a $400,000 strategic loan balance at that time. Essentially, what it means is they would have started a policy 10 years earlier. The policy would be 10 years old at age 65, and they could just write one check as a lump sum, dump it into that policy, and repay the policy loan that was really in existence to help them capitalize this other policy. And the policy just looks like a 10-year-old policy rich with cash value. And that's going to look really great. In fact, it's going to be better than if they had waited until age 65 and started a brand new policy with that windfall money at age 65 at whatever health class, assuming they can even get insurable at that point in time. This is the idea fundamentally of a strategic loan balance in a nutshell, is right there. It can work for many things. We mentioned inheritance. It can also work for things like having retirement programs. In other words, if you have a retirement program and you're in your 50s and you're looking at age 59 and a half and you see on the horizon, it's 4 or 5 years away, you see it sitting over there and you're thinking to yourself, I don't want my money in these retirement programs. For whatever reason, maybe you got other things you want to do. You just simply don't really want it to be in the market, whatever it is. And you're thinking about using it to fund policies at the time, or you'd rather have it be in a safer place or something like that. Maybe you see the age 59 and a half on the horizon, and you know that at age 59 and a half, you won't be penalized with the 10% penalty for early distributions. Of course, you'll pay taxes on your distributions, but you won't have to pay the additional 10% penalty for early distributions. And you see that on the horizon. So you could say, you know what, Nate? Let's go ahead and build the policy now. We'll fund it with the strategic loan balance style concept. And I will just use, when I do turn 59 and a half, I'll take out a distribution then to pay back the loan balance I used to capitalize the policy. That way I can avoid paying the 10% penalty on the distribution while still having a policy that looks awesome in 5 years, even when I repay the loan balance. So things like retirement programs, the sale of your business, and a lot of our clients own a business that may be sold into the future. And once again, if you sell it and you're in your 60s, you sell your business, you have this big lump sum of money, the only way to get it into policies would be to start a brand new policy at that time. And what we're saying is, the question is to you, which one do you want more? Do you want a policy that's been open for 10 years that has a large loan balance on it, but by the time you sell the business, you just refund the loan balance and keep running? Or do you want to have to, at age 65, try to get a new policy in force that's starting in year one, day one at that time? There can be pros and cons to each. I'm just merely saying that's the idea of a strategic loan balance as well. So whether it's selling your business or just simply having assets that will be sold in the future, if you're an investor and you've got real estate and you've got all sorts of different things running around, there will be liquidation events into the future, and you may want to have a place to funnel that money. Instead of having to start a brand new policy every time you have a windfall event, you could choose to create a situation in where you accumulate strategic loan balances, which will help even that out. That's the overall idea of strategic loan balances. It's the idea that you can stretch yourself further than your cash flow will allow you to do it. And it's only for people who have a reason to do it. It's not for everyone. It automatically brings you into stage 4. So a couple things to note on that. You cannot be, if you watch the webinar, you'll understand what I'm talking about. But you cannot be a stage 1 or stage 2 person and accumulate a strategic loan balance. And the reason that can't occur is because there would be no reason to carry a strategic loan balance when you have cash flow that could just be used to repay the strategic loan balance. So in other words, there's no reason to borrow money to create a strategic loan balance if you have cash flow that could be going to premium, but you're not paying it and it's just sitting aside in the bank account. You would just use your bank account to repay the loan the next day anyway. In other words, a strategic loan balance only exists when you already have sufficient ability and desire to max out policy premiums and to max out your free cash flow into policies every year. Then you can even start talking the discussion of strategic loan balance. The reality, though, is the reason why it's not for everybody is because if you don't expect a future windfall, there really is not going to be much benefit to do it. In fact, it could cause some concern and confusion. So we wouldn't just say it's for everybody. You also don't want to get carried away with it. So if your parents, are going to leave you what you expect to be like a $10 million estate in like 10 years, we should create some strategic loan balance, but you don't want to get so aggressive and ridiculous by just starting gigantic policies that are always tapped out with max loans and just be weird with the concept. So of course there's a limitation for everybody. In fact, I would choose to be more conservative than not. I think that for many people, it can make sense to carry strategic loan balances, but they have to be conservatively built, very strategic, where all of the parameters are understood, because you don't want to have people who just get so carried away with it that their loan balances get out of control. That's the idea. So you want to run scenarios on paper before doing a strategic loan balance. You want to have an idea of what it looks like if you never repaid it. You want to have an idea of what it looks like when you do. You want to have an idea that it makes sense for you to do it in your own circumstance. And so you don't want to go crazy with it. In other words, you wouldn't want someone who's making $100,000 a year to be carrying a $50,000 strategic loan balance every year. It's just on top of their free cash flow going into premium. So maybe they're paying $20,000 a year in premium, and then they're paying $50,000 a year in additional premium from strategic loan balances. It just gets out of whack. This is not some sort of magic or miracle thing. I think you guys can catch the picture on that. It is not for everybody, but it is a solution for specific people doing specific things. That's for sure. More often, people with volatile incomes will be attracted to it. People with future windfall events that are pretty known will be attracted to it. People may be attracted to it at small scales for even things like future raises and different things. The way we normally suggest operating with a strategic loan balance is essentially you max out your policy premiums first with whatever money comes in. Any sort of set loan repayment agendas that already exist, you take care of those. And any capital you have left goes to repay your strategic loan balances. So let me repeat that. So how you operate life when you have one is, first off, as always, you max out your premiums for the year. With whatever income comes in, windfalls, we're going to make sure we're going to max out premiums. Number two, we're going to max out, or we're going to make sure we repay the loans that we've already set up to repay. So like, let's say I have a car that I purchased from a policy, I'm repaying it on a set amount. Let's say we have an investment that's returning income, and I'm going to make sure that that's going to repay the loan that I've already set it to operate with. I went on vacation last year. I pulled $10,000 from my policy to be able to fund it, and I'm paying it back at $900 a month so I can go on vacation again this year. I'm going to make sure that goes in. So I'm going to pay my premiums. I'm going to use all of my resources to be able to do that. I'm going to repay the loans that are like set up that I'm repaying. And then if because I had a good year, if because my income is up, if because I had a windfall, if because I sold an asset, I end up with additional funds beyond those, then I just go ahead and write a check and put it back in to pay down the strategic loan balance. I don't need to let it sit there until my parents die and leave an inheritance to me. I don't need to do that. So those are the main areas. It's not for everyone, especially if you're a smaller scale IBC practitioner who income is pretty steady and different things. There's no reason to add the confusion and possible concern of extending beyond your own abilities to create a strategic loan balance and increase premiums if it's unlikely that there's going to be some sort of future windfall event to be able to take care of it. So be wise with it. Anytime you're going to do something like this, you want to be handheld by Nate or whoever you're working with to lay it out on paper to show you what life is going to look like with the strategic loan balance at the forefront. And then as you live life, you're going to pay your premiums and max out your MEC limits as much as you possibly can. You're going to repay the loans that you have set up to repay on a more scheduled basis of sorts. And then whatever's left is going to get chipped down your strategic loan balance. It's going to help even out your cash flow so that every year you can fund as much as you possibly can into policies, whether it's good year, whether there's windfalls, or whether there's not. I hope this has been helpful. We've already been doing this for 40 minutes. I'm pretty tired of talking about it. I think I've hit almost everything I can. I'm sure there's more that I forgot about, but nonetheless, this is the idea of having a strategic loan balance. It is a cool strategy. It's an advanced strategy that allows people to expand their systems and make them larger than they otherwise could. And it's for specific purposes. And you can operate with a strategic loan balance in a way that's very beneficial to you, but it may not be beneficial to everybody. So come talk to us if you think you might have a situation that fits it. Then we'd be happy to play it out with numbers on a page and show, yep, this does seem to fit And this is what it looks like if you are able to repay it. This is what it looks like if it doesn't. In other words, you don't want to run into a strategic loan balance and have no clue what you're doing. That's the fundamental truth. You want to know what you're doing when you're operating with a strategic loan balance. Well, it's been fun, guys. This is Nate. Once again, if you have questions on this, feel free to email me. Anyone's welcome to do that. My email is nate@livingwealth.com. I'm happy to chat with you. Besides that, I wish everyone the very best. Thanks again for listening. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/beatinflation. You'll gain instant free access to the beginner's course Ray, Nate, and Holly made just for you. Again, that's livingwealth.com/beatinflation.